All right, welcome back to another mortgage interest rate update, this time for July. There has been lots of action in the last month, as there has been for the last 3 or 4 months in the interest rate world. We've seen 5-year fixed rates go up quite substantially again this month. However, we are seeing a little bit of a reprieve from rising interest rates and rising bond yields as global markets essentially get beat up by recession fears. So that is a good thing. That means these 5-year fixed rates hopefully will start to come back down, and we're going to see a little bit of an opportunity to lock in at some lower 5-year rates. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget, if you want to know all the secrets to getting the lowest interest rates in the Canadian market, you can get our Secrets to Getting the Lowest Interest Rate course at ratesecrets.ca. This is going to be one of the last times that you'll be able to buy that course. So if you want that information, this might be your last chance. It's designed to get you at least 10 to 50 times your money back. Again, ratesecrets.ca if you want to save big time on your mortgage. Okay, so let's get into it. Let's discuss interest rates for July of 2022. Let's start first and foremost with prime rate. It remains unchanged from last month, but it is widely expected that this interest rate will go up to at least 4.45% on July 13th. So expect that variable rates will go up accordingly. They could go up even more than that depending on what the outlook for the economy looks like, but rest assured this rate is increasing this month, and we'll give you an update when that happens. Now, we talked a little bit at the beginning in the intro about the fact that 5-year bond yields are starting to come back down. At the beginning of the month, we saw 5-year bond yields go as high as 3.6%. That is the very peak that you see on this graph. We are now seeing them come back below 3%, which is about where they were at the beginning of June, which means we'll hopefully see interest rates going back into that 4.5% or maybe even that 4% range on a 5-year fixed. But these bond yields, which the 5-year fixed mortgage rates are based off of, are going down because of recession fears. So up until this point, most of the interest rate increases from the Bank of Canada were priced into the bond market yields. Now what we're seeing is the bond market pricing in not as many interest rate increases as a result of, again, those recessionary fears, as a result of less growth in the economy, less GDP growth, and a little bit of a worry about jobs going forward. So let's get into what you've come for. This is the 5-year full featured rate. It is now over 5%, 5.04. This is, of course, for insured mortgages or greater than 35% down mortgages. These are the mortgages that have the least risk for the banks, which is why they are the cheapest. If you're putting between 20 and 35% down, those are the most risky mortgages for the bank because that is the least amount of down payment that you can put down without those mortgages being insured. So you're going to pay a little bit more for those. And for those mortgages, you're going to pay between 5.04 and 5.29%. And again, as you get to the bigger down payment, the mortgages get cheaper. So basically, if you're putting 20% down, expect on a 5-year fixed mortgage right now, you'll be paying about 5.29%. As for variable interest rates, we've actually seen these come down a little bit as banks are getting more competitive in this summer market. So if you want a 5-year full featured variable rate mortgage with insurance or greater than 35% down, you can get that for 2.75% right now. By the way, what's a full featured mortgage? Well, this is the type of mortgage that has lower penalties, the ability to pay back the mortgage faster, and less fees associated with breaking the mortgage. And by the way, these are very often not at big banks. They're with what we call A+ lenders that have better products than the banks because they specialize in mortgages. Be careful when you talk to your bank about lenders like First National, MCAP, CMLS. The banks will call them B lenders. They are not B lenders. They actually have superior products in a lot of ways to what the banks will sell you. And by the way, I'll link to a video up here that explains all the differences between the best lenders in Canada when it comes to getting a mortgage. Now, if you're looking to put between 20 and 35% down payment, again, you can get into a 5-year variable rate at 2.75% if you're putting closer to 35% down, and it'll cost you about 3.1% if you're putting 20% down. Now, moving into the discounted rates. These are the rates that have certain features stripped away or have excessive penalties to get out of. So there's some things that come along with these mortgages that end up potentially costing you more over the long run. In the beginning, you end up getting a lower interest rate. We call that basically front loading. And if you end up having to get out of your mortgage at some time in the first 5 years, chances are these are going to cost you significantly more to get out of. Because just like anything else in life, you get what you pay for. And when you get a really ultra low rate on your mortgage, there's a really really good chance that you're getting less value for your money. So stay clear of these, but we're going to tell you what they are anyways. If you're looking at a 5-year fixed fully discounted rate, you're looking at 4.84% right now for insured or greater than 35% down payment. If you are in between that 20 to 35% down payment, you're looking at 4.84 to 5.09%. And if you're looking at 5-year discounted variables, you can get those for 2.55%, which is a really great rate. The problem with these rates is that if you decide to lock in at some point, you have no negotiating power. You can't leave and go to a different lender. And therefore, you pretty much have to lock in at whatever the lender tells you, which could be a great rate, or it may be an awful rate, and you may be forced to stick it out in your variable as a result. So for a 5-year discounted variable, you can get it at 2.55% right now, insured or greater than 35% down. And for a 5-year discounted variable with 20 to 35% down, you're looking at 2.55% to 2.9%. Of course, with that higher rate coming with that smaller down payment. And those are your interest rates for July of 2022. So they have gone up substantially on the 5-year fix, although it looks like we're going to get a little bit of relief from the upward pressure, at least for the time being. And those variable rates are getting a little bit more competitive again. For most people, they are still choosing variable rates because of the significant difference between variable and fixed rates right now. And by the way, it is widely expected by economists that there will be a point where variable rates will start to come back down as the Bank of Canada starts to get inflation in line with 2%, or as they tank the economy into a recession. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, share it with your friends, hit that like button so more people like you can see it, and we'll see you on the very next one. Cheers.